As a follow-up to our discussion on cost of capital, there's need for us to take at least one or two examples. You recall that I said at that lecture that the cost of capital is a result of the need for us to estimate the cost of the various sources of capital so that we are able to arrive at the rate to be used to, appraise our investment proposal. There's a rate which must be used. This is a rate of return which is used to capitalize our expected cash inflow. That rate is estimated by the rate to be used is actually estimated from the overall cost of capital, the cost of the various sources of capital, the cumulative which is the cumulative cost of capital or the overall cost of capital. There are basically three decisions in finance. Number one is the investment decision. Have you decided to invest? Then you must look for appropriate funds to fund such investment. It is the cost of this investment, the rate of that is used to discount, like I said, to discount the proposal, the cash flow that is expected. Let's take the other one is the financing decision. Aside from the financing decision, we have what referred to as the dividend policy decision, with the return of profit to owners of capital. Let's take this example on Oreluwa PLC. Oreluwa PLC has a capital structure consisting of 100,000 naira ordinary share and 50,000 naira 12% debenture. The ordinary shares are currently valued at 75 kobo, and the value of the debenture is currently 80 naira. The dividend is assumed to have been paid and is running at 10 kobo per share. Therefore, debenture interest is also assumed to be regularly paid. We are interested in estimating the cost of equity, the cost of debt, as well as the overall cost of debt. It is the overall cost of debt that is the issue. That's the issue. Like I said, is the hurdle rate, is the rate that will be used to appraise our investment proposal. That is to discount the forecast of cash inflows in the future. When we have a project to be considered for investment. Now the cost of equity. I told you in the last lecture that the formula for estimating cost of equity is KE, which is the cost of equity, is equal to the dividend payable all over the market price of shares. And this is the market price taken as S dividend after dividend has been paid. The market price after dividend has been paid. That is S div. If you have the market price is given, if it is cum div, that is the dividend is still there. There is need for us to therefore remove the dividend, because we cannot use the market value cum div to estimate the cost of equity. We use the market value S div for the estimation of the equity. Hence, there will be need for us to remove dividend elements when dividend payment has not been removed from the current market price of shares. So the formula therefore is the D over PO. D, probably D subscript 1, that is dividend that have been declared and have been paid. Here we can see from here that from this question, the dividend is 10 kobo per share. 10 kobo per share, and that's how we arrive at 0.10. And the market price is given, the market price SDIV is given as 75, value at the ordinary share is currently valued at 75 kobo. 75 kobo. And so we have 0.1D all over 0.75 P0 SDIV. Hence we have 0.113 multiplied by 100 will give us 13.33%. That is the cost of equity. The cost of equity will be 13.33%. Well, let's move to the next one, which is the cost of debt. Debt is the capital provided by outsiders, external fund. External fund attract return. There's a rate of return that is attached, and interest that is due on debt must be regularly paid. If it's not paid in any given year, it is carried forward, automatically carried forward. It's cumulative for interest payment in the next period. is not lost. Dividend, interest payment on debt is not lost. There are two types of debt, as I explained in the last class. We have irredeemable, the one that is not expected to crystallize. The debt will not crystallize. It remain in perpetuity. Perpetuity in the first book, it remain in perpetuity, and the debt holder hold it and perhaps pass it on to the yet unborn children. But it's not very common, in modern companies. The other one is what referred to as redeemable debenture, in which case, debts are supposed to be repaid. It has a time, a tenor, a time when it crystallizes, when the principal that is invested is supposed to be repaid. Principal is therefore returned to the owners of capital. Such debt are valid. This different perspective of looking at debt, they are valued separately, differently. For irredeemable debt, like the one we have here, for Orelua PLC is an irredeemable debt. Very simple. All we need to do is to find the proportion of the interest element to the market, the market value, the current market value of the debt. Will give us the rate that we are looking for, the current rate of the debt, the cost of debt. And as I explained earlier, what is cost to the company is the return expected by the holder. So it just, the different faces of the same coin. What is debt to a company that is making use of that fund to promote its business is the return to the debt holder, right? The other one is what I refer to as the redeemable debt. In the case of redeemable debt, aside from the interest component, there's need to value also the repayment of the debt, the repayment of the debt component. As I told you in the last session on the theoretical aspect of this course, there's the interest component, there's the repayment of the principal component, the two of them. We cumulate it together, we must value both together for what? For redeemable debenture. And we can easily do that for, by using a number of ways. The most popular way is using what we refer to as the interpolation method. The interpolation method will get us there. Just like as we estimated internal rate of return, is just the same method can be used to estimate our redeemable debenture. But let's go back to this question on Orelua. A very simple one. We have the cost of debt. It's a straightforward one. It's an irredeemable debt because we don't have any date attached, at which the debt will crystallize. If we have a date attached at which the debt will crystallize, as we did debt will crystallize in the year 2025, then it becomes our estimation of the cost or the return, for the investor, or the cost for the promoter, will be different. But since there's no date attached, so it's assumed, which is the case anyway, to be an irredeemable debt, right? So what do we do? What we do is that the interest component, as a proportion of the market value, the interest component, it is reasonable to assume that if the face value, yes, maybe you may call this an arcade question, that the face value of the debt in this case is 100 naira. That is the assumption behind it. If the current market price is 80 naira, then it means that the debt was in each face value of the asset when it was issued must be 100 naira, right? So if it is 100 naira, it means that the interest rate will be what? Since the rate of return is 12%, it will be 12% of 100 naira, right? 12% of 100 naira, which will give us 12 naira, as we have there, 12% of 100 naira, which is the face value of that debt, all over the current market price of the debt, right? The market price of an instrument could be above the face value or below the face value, depending on how the law of demand and supply of such security in the market, right? So it could be above a premium, or otherwise, so in this case, you can see that the value is now 80 naira. The current market value is 80 naira. So that we get the cost of debt to be 15%. An SDT is for us to be able to compute the cost of both equity and debt together, the cost of both sources of capital. In this case, there are two sources involved. And like I said earlier, that our advanced discussion in finance is that our analysis is usually limited to equity debt analysis, because all the other sources of fund can either be classified as equity or debt. Retained earnings, for instance, retained earnings can be classified as an equity, because it's a dividend that is due to be paid for shareholders, but is retained within the organization, to finance expansion, expansion project of the company. Instead of paying it out, instead of raising funds from outside, which will take time, which we also cost, and a lot of things. You have to go in before you raise such fund. Firms can decide to retain, dividend within the organization to be plowed, by which we sometimes refer to elementarily as plowing back profit, retained within the company for expansion purposes. So that is a preference. In the case, you can see that from this formula is nothing but a weighted average. A straightforward average will be add the various sources and we just divide by the number of sources. But here it's not the case. It's a case of weighted. We weight each of the sources by what? By the cost of each of the sources multiplied by the value of that source to the overall value of the firm. Here instead, for instance, equity. Equity is the cost of equity multiplied by what? The proportion of equity in the overall value of the firm, plus the cost of debt multiplied by debt as a proportion of the overall value of the firm. The V is the overall value of the firm, and the D is the debt component. Here, the V here is also the overall value of the firm, and the E is the equity component. And the K and KD is nothing but the cost of that source of fund. Hence, having said that, we proceed to find the cost of the overall cost of capital. The overall cost of capital, therefore, is the cost multiplied by the proportion of equity to the overall value of the firm. 75,000, is the current market price of that of this year, and the overall value of the firm is nothing but the value of equity plus the value of debt. That is, V is equal to E plus what? Plus D. V is equal to E plus D. Since we have this at 75 and we have debt to be 40, 75 plus 40 will give us 115, which is the overall value of the firm. E plus D, the overall value of the firm. E plus D. Or if you have other sources, you must add all of them together to give us the overall value of what? The overall value of the firm. So for this question on Orelua, we can see that it is the cost of equity multiplied by, like I said earlier, the proportion of equity to the overall value of the firm, plus the cost of debt multiplied by the proportion of debt to the overall value of the firm. Hence we have 0.086 and 0.057, and multiplying, doing a multiplication by 100, the percentage, we have that the overall cost of capital, for this firm is 13.91. 13.91. You see, this will therefore, KO will be the rate, the discount rate to be used by Orelua in accepting project for implementation. That is the implication. And that's what I refer to it as financing decision. It portends the fact that this is supposed to be the minimum cost of capital. We try, an analyst will try as much as possible, a company try as much as possible to minimize the cost of its capital, such that impliedly the overall value of the firm will be maximized. When we started this discussion in this course, I want to bring to your memory what we discussed then. We said one of the objectives of a firm is to maximize owner's wealth. And you maximize owner's wealth by maximizing the value of the firm. When you maximize the value of the firm, it will trickle down to maximization of the market price of the shares, and then the wealth of owners will therefore be enhanced. That is one of the key objectives of finance, of a firm, objective of the firm. And so 13.91 becomes what? It becomes the hurdle rate, the minimum rate that is acceptable for an entrepreneur, for a manager to accept any project for implementation. In fact, it is the rate that that this individual, this investor, will use to discount the future inflow from a forecast, of the cash flow forecast that you want to evaluate concerning a project. That is the import of our estimation of the cost of capital, or the cost of the financing mode. I most sincerely thank you for listening.